In this video, we're going to talk about Sofi Technologies, trading under the ticker symbol SOFI. At the moment, the financial market is very volatile, and we gotta be careful about which stocks to buy and the exposure and timing of our trades. This video is going to cover the recent price actions and the technical aspects of the stock. Before today's video begins, a quick heads up that my analysis is based on sessions already completed, and that it's about the overall trend and may not always focus on the latest price actions for the immediate term per se. If there are significant events occurring, I will make follow-up videos to reflect them. Alright, let's begin with today's topic. During the most recent trading session, the stock decreased to $7.86 before closing the trading day at $8.20. We gotta pay attention to the $7.90 nearby because it was tested 2 times as a support and then rebounced from there, making it a significant support level to watch out for. Over the past 30 days, the trend of the stock has been bearish, as the stock lost almost 40% of its stock value during that period of time, and the market was not very lenient with the fintech company. In a general environment that is already challenging due to the Nasdaq sell-off that has been going on for a few months. From the perspective of a longer time frame, which is 6 months and above, the trend of the stock has been bearish, as Sofi lost almost 50% of its value since the beginning of 2022, and so far the title is still, I would say, in the middle of a major market correction. Nevertheless, we should start thinking about a possible entry in the stock, because it seems like the bulk of the bad news is already in the open, and that Nasdaq, and this is more important, Nasdaq itself may also be having signs of bulls that are silently coming back over the past few days, and I suspect that this phenomenon will further amplify itself over the next few weeks and months. When we look at the price trend overall, the downward tendency has been ongoing, and with some signals that it may be slowing down during the most recent days. Although it's still too early to say that the bearish trend is behind us, what is certain is that the stock has been highly correlated with market directions overall, and that we should take that factor into consideration. The trading volume of Sofi Technologies has recently been 52 million shares versus the average volume of 67 million shares. Over the previous 52-week period, its price fluctuated between $7.74 and $24.95. The market cap of Sofi Technologies is currently at $6.6 billion versus the enterprise value of $16.6 billion. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If it has a lot of debts or has a very negative image amongst market participants, the assets value may be impaired. With that being said, at the end of the day, this remains an estimation of the market every single time it publishes its financial statements, so it's less reactive than the market cap, as this would be updated every single trading day, and more often than not, lenient for the startups. One key element to note regarding the enterprise value is that for many growth type companies, one of the most significant assets they own is the goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or to have more growth than another company, partially because it may have a better management, a stronger brand recognition, and a bigger online following. It is basically what is unique about this company in particular compared to an alternative competitor. It's not a tangible asset that companies may use, but it's often the reason why some companies are perceived to be trading at a discount, since the market cap is lower than the enterprise value, especially in very volatile situations. If the company goes to liquidation, there won't be any distribution of goodwill, and we would be left with potentially much less assets to distribute than the balance on the financial statements. When we compare the current price to the historical price fluctuations, the stock is currently 6% higher than the 1-month low, 6% higher than the 3-month low, and 6% higher than the 52-week low. On the options market, which gives us a hint about the market sentiment of where the stock price is likely going to head toward. The implied volatility here is 98%, compared to a historical volatility of 83%. The put-call volume ratio is currently at 0.14. It is normal for most stocks to also tend to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 110,000 contracts versus the 30-day average of 165,000. Regarding the open interest, the most recent volume of open interest is 1.6 million contracts versus the 30-day average of 1.5 million contracts. In terms of its shareholder structure, institutional owners have about 49% of the outstanding float. The biggest shareholders include SoftBank, Vanguard, and BlackRock. It is relevant to understand that the shareholder composition of a company can matter a lot, because it helps us to determine if you should hold the stock long-term or to view it as a short-term trade opportunity. If the stock is mainly held by retail traders, this can be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there gotta be about 25 to 30% of institutional ownership for the stock to be perceived as an investment and not just a trade. This is obviously subject to a lot of exceptions, as many great companies, although startups, but great companies, are mostly held by retail traders as well. But this so far tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price goes lower. If there are significant short interest in the total volume, this can be potentially a sign that something more organized is going on. The current short interest is 16% of the total floats and 41% of the transactions coming out from the dark pools. My opinion on Sofi technology overall is bullish for the long term, and I would like to keep it on the watch list for the immediate term. The timing may be ripe to start buying in small quantities as well for those who are willing to take the risk. The maximum exposure I would recommend is 1 to 3% of your portfolio. For the immediate term, my recommendation is to buy the stock considering the recent price actions and the promising price levels that are close to where the stock is right now. I would recommend to separate the allocations in batches of 10% at a time so that you can have enough room for dollar average strategy. In the current market environment, I think that we should be careful about taking positions in the financial market in general, especially when it comes to equity market. Over the past decade or so, the financial market has been living with the help of newly created capital from the quantitative easings, which resulted in the increase of asset prices and the corresponding collapse of their yields. Of course, the low interest rate also contributed to reinforce that phenomenon because the financial sector would first of all see its profit margin squeezed, which will in turn keep the returns of other sectors low as well. At the same time, the market doesn't represent the real economy, and the real economy often doesn't get reflected in the prices of their own securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. And I want to say that fundamentals sometimes doesn't play that much of a role at all. If the asset prices only depend on the fundamentals, then their performances in Northern Hemisphere would have been more than mediocre, because things have mostly been stagnant over the years, ever since the last economic recession. A few things can explain why asset prices managed to remain high during these years, despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their local economies. But because that money is distributed to banks and expected to be loaned to businesses, and that there aren't that many opportunities in the real world. The money went into the financial sector to buy up assets. Of course, the QEs are wrapping up in many countries, so for the next couple of years, it's not going to be the main driving force to keep the asset price high. But it's compensated by the arrival of new capital from different regions in North America because it's still perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be a sustained phenomenon over the years to come. The last phenomenon is the creation of artificial bubbles that are either supported by the real market trends or completely fictional to allow market participants to play the game of hot potato and to either generate profit or to safekeep their capital. Of course, the people who end up with the hot potato lose money, but that's another story. The EV sector in 2020 is an excellent example of this. Nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially in Asia. This means that the market is expected to see its volatility increasing over time, which will provide opportunities to make a profit or to incur losses depending on the timing and risk management of those portfolios. Another thing to note for this period of time is to be very careful with having short positions. Usually, it's already more risky than having long positions because losses are not limited. And with the increased involvement of retail traders, I believe that the stocks being shorted will have a higher probability of getting squeezed, and this will occur randomly, which will result in potentially massive losses. We're also observing very often people will choose to rush in positions not necessarily because the fundamentals are convincing, but because there is a buildup of demand in a specific stock and that people will pile in to ride the gravy train with the rest of us. This kind of behavior is highly risky and may result in heavy losses as well. It's worth pointing out that in 2020 and probably in 2021 as well, the financial market has never presented that many opportunities, but it's also during this period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. The positions should also begin small so that there is an opportunity to average down later. Typically, the growth stocks would take about 5 to 10% in my portfolio overall, and each and every one of them represents maximum 1% of my portfolio. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.